Hell is coming. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, millions of Americans are about to lose their jobs. I've got the shocking proof, and more importantly, what I want you to understand is more Fed rate cuts won't save the economy. Now let's head over to Bloomberg, where I want to show you what happened at midnight last night, because as you're about to see, it's only going to make what's happening in the manufacturing sector much worse. As the strike shuts down eastern U.S. and Gulf ports, threatening to send the U.S. economy into a recession, the significance of a work stoppage at every major container port from Houston to Miami and New York, New Jersey depends on how long the strike lasts. The economic loss from the shutdown, which began at midnight, will be between 3.8 and 4.5 billion a day. This is according to JP Morgan, and this is something that the U.S. economy right now does not need. If there's this hope that we're going to achieve a soft landing, we need to see consumer demand driving factories, driving new orders. But as you're about to see, there's deeper problems with the economy, and this strike's only going to make it worse. As the International Longshoremen's Association is seeking higher wages and a rollback of the language on automation in a 6-year contract that expired at midnight. Union leader Harold Daggett has said for months that he's threatened to strike on October 1st if no deal is reached before the deadline. And the last time this happened was 1977. And you start to think about what they're looking for is they don't want automation, in addition, of course, to higher wages, which is exactly what most workers want right now. But if you bring in automation, what it does is it gets rid of jobs, and that's a key point. And we are prepared to fight as long as necessary, Daggett said, to stay out on strike for whatever period it takes. Last offer from the companies fell far short of what the ILA rank and file members are demanding in wages and protections against automation. And if demand in the economy was strong like now, this would be a boom for U.S. factories. But there's a huge problem. Consumers are balking at higher prices and their wages aren't keeping up with inflation. And this is the worst news for the U.S. factory sector at a time when you're about to see they're already laying off more people. Trade, transportation, and retail industry groups have been urging the White House to step in and intervene to limit damage from the strike, but so far the White House has no desire to do that, as container carriers are now preparing to impose surcharges tied to disruption, raising the overall cost of shipping. But the other issue here, if goods can't get in the country, well, that means as products go off shelves and exit warehouses, prices are going to go up. The problem then underneath all that, again, comes back to consumer demand. This is very interesting because the timing of the strike could not be worse for the U.S. economy. The president can protect manufacturers and consumers by exercising his authority, and we hope he'll act quickly. Of course, we know he's not due. But let's talk about what's coming for the U.S. labor market and why the Federal Reserve is behind the curve here, because the S&P Global and the ISM reported the purchasing managers indices today. Check this out. Factory employment falls at a sharper pace as manufacturing downturns deepen. And we see the sharpest fall in new orders as job shedding intensifies and output price inflation quickens despite slower rise. So what are we seeing here is stagflation in real time. We're seeing input prices go up, which means manufacturers are going to have to raise their prices at a time when consumer demand is falling. The evidence of that is in the new order book. They're not coming in. And when you start having an issue where prices are going up, sales are going down, and new orders are falling, well, you don't need employees. We said this was going to happen, and what it turns into is not significantly higher inflation. You do get a bout of inflation, and then as you know, you get a lot of disinflation, potentially deflation after that. But let's dig into the report, because the seasonally adjusted S&P Global U.S. Manufacturing Purchasing Managers Index remained below the 50 no change mark in September, dipping to 47.3 from 47.9 in August. Now, the way you read that is the manufacturing sector contracted further from last month. That's not a sign of a no landing or soft landing scenario. What this says is the manufacturing sector is getting worse, and the strike isn't going to help. I'll show you why. Because central to deterioration in business conditions was a sharply worsening demand environment, meaning consumers weren't buying. Amid a slowdown in the wider economy, and uncertainty around the upcoming presidential election, which many actually are hoping is keeping money on the sidelines. But the reality is, I talk to a lot of people and I ask them, if you get the president in office you want, are you going to spend more or less? And their answer is, our spending isn't going to change at all. But many people are looking for an excuse, and this signaled a third consecutive monthly worsening in the health of the manufacturing sector, and one that was the most pronounced since June of 2023. New orders decreased for the third month running, with the rate of contraction the sharpest in 15 months. And this is important to understand, because if goods are not moving off of a retailer's shelf, well, that means things aren't coming out of their inventory. And if that's not happening, then they're not ordering from the wholesaler who's clearing their shelves. And if their shelves are staying full, they're not ordering from the factory. And so what you see here is, at the factory level, it all goes back to the consumer. It's telling us they don't have the money, they're unwilling to pay higher prices, and that's going to lead to mass unemployment. Even new export orders were also down to a larger extent in August, as geopolitical issues and demand weakens, notably here in Europe, which led to a fourth consecutive decline. Of course, we know the European economy is doing worse than the U.S. economy. Manufacturing output decreased less quickly than new orders, as firms worked through outstanding business and adding to holdings of finished goods. Now, this is important because we've been asking the question, when do all these backlogs go away? Because right now, the fax machine on the new order book isn't spinning very much. However, there's enough backlogs that the workers get assigned to that. But what happens when you run out of backlogs and you don't have new orders? Well, the factories are building inventory because they don't want to get rid of these employees. Now they're facing a problem. Demand isn't coming back. There isn't an existing work to do, and they built up an inventory. And that means, of course, hours work gets cut and jobs get lost. The resulting drop in backlogs of work was the largest since January, while post-production inventories were accumulated for the third month running, suggesting we are at an inflection point, as firms also reduced employment for the second consecutive month in September, just as I predicted would happen. The fall in staffing levels was the steepest since January 2010 if the initial pandemic period, 2020, is excluded. So what we're seeing now is the U.S. economy take a sharp move down. Many people have been saying in the comments, why is it going so slow? Why is all the data suggesting we're in a recession, but we're not seeing the economy come crumbling down? Well, my friends, you're starting to see that now. Let's talk about why this is happening. Again, it all comes back to the consumer. As we look at advanced retail sales, this shown in red against manufacturers' new orders of durable goods, you see the relationship here. When sales dry up, well, new orders go away, because again, if retailers are not moving products off their shelf, out of their inventory, wholesalers aren't, and next thing you know, orders dry up and workers at the factory level start to lose their job. And that is validated on this chart as we look at new orders again in blue on a year-over-year rate of change against the unemployment rate shown in red. And what do you see most often when you see a decline in new orders, or worse, a contraction when it falls through that horizontal black line? What happens to the labor market? Well, it stops that downward trend in unemployment, and when it gets severe, it causes an upturn as more workers hit the unemployment line. And the problem is there's no outlook for them to go get another job. That's the risk here of this economy. You see it happen here again during the global financial crisis, and you see the early signs of it now. And since we're getting word from manufacturers they're laying off, this is a huge risk, because this means millions of Americans are going to hit the unemployment line. But you might be thinking, wait a minute, isn't this strike good for U.S. manufacturers? Well, hold up. Remember, inventory is being built here. This would be the opposite. If the U.S. economy was strong and robust, and there wasn't, of course, all this inventory being built up, then yes, the strike would be bullish, because orders would hit U.S. factories that would keep Americans at work. The problem is consumers can't afford these higher prices, and they don't have the money. And again, you look at the timing of the strike and what's going on with the manufacturing sector, this could very well what sends us into a recession along with the rest of the world. Let's take a look at the ISM manufacturing PMI. It dropped to 47.2. Look at this. You see the word contracting, slowing. This is not, again, a good sign, as the two reports are validating each other. Here we can see that new orders continued to contract, although not as fast as they did month before. But look at employment. You see a much larger contraction here, going from 46 to 43.9. This is exactly what we predicted. Now, the ISM isn't saying inventories are getting built built. In fact, they said that inventory at their level dropped a little bit, but customer inventories are unchanged. So perhaps you have some effective channel stuffing here where manufacturers are just forcing products out the door so things don't look as bad. But underneath here, you can see the fact that they're laying off is a red flag. And as we look around the manufacturing sector, we don't see opportunities for these workers. Here you see now for the 24th straight month, the backlog of orders is contracting. New export orders contracting for the 4th straight month. What you see is absolutely no demand, no work, and that is being reflected in this report. And here you can see what respondents are saying. North American demand has started to weaken. Global demand remains soft. A continuing low order rate is not good. Fourth quarter is slower than anticipated. Business is flat. Our sales continue to be flat, and sales have slowed this quarter. Remember, all of these manufacturers were hopeful that there would be a second half rebound. They bought into the narrative of the Fed, and in their survey data, they're citing issues like, well, we need more Fed rate cuts. Well, we need the election issues to go away so people will be confident. But the problem is the rate cuts aren't working. The rate cuts are not going to bring consumers to the door, and that puts Powell now behind the curve. And yet he says, well, we're not in a hurry. We'll lower rates over time, except he doesn't realize, based on what we're seeing in the manufacturing sector right now, which transmit with a lag to the services sector, well, that means, of course, he's going to be in a panic in November. Watch and see. As he's looking forward, if the economy evolves broadly as expected, policy will move over time toward a more neutral stance, Powell said. But we're not on any preset course, he said, noting that policymakers will continue to make decisions meeting by meeting based on incoming economic data and based on what we're seeing in the manufacturing sector. It says the unemployment rate's about to go up. And so one thing the Fed said is a non-negotiable item. They don't want to see more Americans hit the unemployment line. The problem is they're going to, and as I said in the beginning of the show, more Fed rate cuts aren't going to solve the problem, because when we go back and look at the federal funds rate against the unemployment rate, that's shown in red, what you can see is once the unemployment rate starts to spiral out of control, Fed rate cuts do nothing to stop it. And not until, at least if you believe in the magic of the Fed, there are substantial cuts. We're making the claim the Fed's going to get back to zero. Many experts say not a chance, but remember, they were at zero here following the financial crisis. They were at zero again after the pandemic, and now where are they going to go? You have no choice. They made the fastest rate increases in history, and watch them make the fastest cuts in history. A neutral policy is one that neither stimulates nor holds back the economy. The Fed's current benchmark rate, which officials lowered to a range of 4.75% to 5% earlier this month, is widely regarded as still restricting economic activity, which means Powell knows this. In fact, he said this in his press conference that they believe policy is still restrictive, setting up a move for more rate cuts. It's coming in November, and then watch, December, and every month after that, they're going to be cutting because the bond market's telling them very clearly here that you got this wrong. And now when we look at the federal funds rate still shown in blue against two-year treasury yields in red, what do we see? A complete breakdown here in two-year yields. They're falling. They're telling us financial conditions are tightening. They're telling us that low interest rates are not stimulating the economy. And every time you see the Fed cut, it's not because of inflation. It's not because of the labor market. It's because two-year treasury yields, as you see in red, lead the federal funds rate each and every time. The red flags are going up. The Fed is behind the curve. And as we know, they're completely powerless to stop it. A 50 basis point cut or even a 100 basis point cut at this point is not going to make any change. And you start to look at this strike of these workers. How long will that go on? We don't know. But it has the potential to do severe damage to the U.S. economy and send us plunging into recession. Powell said on Monday he described the labor market as solid, but said conditions have clearly cooled over the past year. And what he doesn't know is, well, they're about to get ice cold. And we don't believe that we need to see further cooling in the labor market conditions to achieve 2% inflation. And he's right, because if we see further cooling in the labor market, or, well, it gets frozen up, well, that means inflation's going to not just hit 2%. It's going to go crashing right through that. Here you can see the unemployment rate in red against the consumer price index in blue. That's shown on a year-over-year rate of change, and you can see as people hit the unemployment line and get stuck there, well, their spending power goes down, and that means, of course, inflation is no longer a problem. You get disinflation, or like you see here in the global financial crisis, all-out deflation, were setting up that move. We predicted that this would happen. Many, including the Fed, said we're going to see another bout of inflation. We said not a chance with the labor market coming unwound. Sure enough, that is the path that we're headed, and fresh figures on the labor market are due Friday, as economists believe 150,000 jobs were added in September. That is, if you believe the non-farm payroll report, which we don't. But if we did, that would be consistent with a moderating labor market. The unemployment rate, which has climbed this year, is seen holding steady at 4.2%, which is the ceiling of what Powell said he wanted to see it go. We think it's going a whole lot higher, and the reason hell it's coming is because when millions of Americans lose their job and have no opportunity to get back to work and are forced onto unemployment, their wages are going to drop, their spending is going to drop, and next thing you know, it won't matter how many rate cuts, we'll be headed into recession. And with our banking system already in dire shape, particularly small and mid-sized regional banks, we're set up for a financial crisis. You can see it coming in China, you can see it coming in Europe, and you can see it happening here. Something we're bullish on is a stock for our sponsor for today's show, Immix Bioarma. You can find them on the NASDAQ under symbol IMMX. All the information in the pinned comment and description below, because there's big news coming for Immix and something we think could make you a lot of money. Let's talk about how they just recently dosed their first patient in their US AL amyloidosis trial with CAR-T NXC201. The lead site is Memorial Sloan Kettering Cancer Center, and the data from the U.S. clinical trial reported at ASGCT 2024 showed a 92% overall response rate. And Immix, a clinical stage biopharmaceutical company trailblazing cell therapies in AL amyloidosis and autoimmune disease, today announced that the first patient has been dosed at MSKCC in its U.S. NexaCAR-2 trial with NXC201, a sterically optimized BCMA targeted CAR-T cell therapy. The NexaCAR-2 study is intended to evaluate the safety and efficacy of NXC201 in relapsed refractory AL amyloidosis patients with adequate cardiac function who have not been exposed to prior BCMA targeted therapy. The study builds on positive data from the initial outside the U.S. study, NexaCAR-1, presented at the 27th annual meeting of the American Society of Gene and Cell Therapy, which showed a whopping 92% overall response rate in relapsed refractory AL amyloidosis patients. The best responder experienced a 28-month duration of response, as reported back on May 10th of 2024, with ongoing follow-ups. And back in August, Immix expanded its U.S. clinical trial sites for relapsed refractory AL amyloidosis trial NexaCAR-2. They've now added Cleveland Clinic, UC Davis, and Sutter Health, with a lead site still at Memorial Sloan Kettering Cancer Center. And again, data from the outside the U.S. clinical trial reported showed a 92% overall response rate. Let's talk about their pipeline and what's coming for NXC201, because it's entering phase 2. This is big news. This is really where you want to be looking at the stock for this company as a potential investment opportunity, because this is indeed a blue ocean opportunity, as a sizable U.S. market for NXC201 for relapsed refractory AL amyloidosis patient population currently is 33,000 patients, and there's newly diagnosed U.S. incidence of 4,000 patients. And NXC201 is a better solution for what's on the market today, and they've received FDA orphan drug designation for NXC201 for AL amyloidosis, and they're on track to dose NXC201 patients in the United States. Let's talk about the investment opportunity and the comparables to Immix, because at one point they traded nearly at $8 a share, and now they're trading back near their lows, and this is a tremendous opportunity because they're currently in phase 1b/2a trials, exactly where Tasha gene therapies were. So this is a pivotal moment. And let's talk about these comps here, because they saw their stock go from 75 cents to over $2 on the release, and this continued until the stock hit $4, and to this day it hasn't traded below a $1 per share. And this happened after the first patient was dosed with TSH HA102 in phase 1/2 trial. Again, creating the opportunity here to get into Immix Bioarma at a low point on the back of this impressive results from their trial. Let's take a look at another comparable, because clinical data updates on the first 3 patients in Ambrx's trial back in February 2023 led the team into getting acquired by Johnson & Johnson in March of 2024 for $2 billion, which is greater than 4 times where they were when they announced their February 2023 update. And here you can see that release, because again, Ambrx was a clinical stage biopharmaceutical company with a proprietary synthetic biology technology platform designed to develop next generation antibody drugs in an all-cash merger, again creating a tremendous opportunity again for Immix Bioarma. And this is something the insiders are buying, and buying big on, giving you the confidence that they know what's coming down the pipeline as they look to see big moves in their stock price and a potential acquisition. Here you can see the independent director of Immix Bioarma recently bought stock at $2.23 a share, and you can see other insiders buying as well, creating a tremendous opportunity for you to get in before the big news comes out on NXC 201. This is your opportunity. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.